My company is tiny. Do I really need an audit? It's one of the most common questions we hear from founders running Hong Kong companies, and there's a lot of confusing, outdated information out there. So here's the honest answer up front. If your Hong Kong company is active, even slightly active, the answer is almost certainly yes. Hong Kong has no small company audit exemption, but there is one genuine exception, and one widely misunderstood rule that trips up many founders. In this video, I'll explain exactly who needs an audit, the one real exemption, the misconception about small company rules, and how to get through your first audit smoothly. The rule: every company, every year. Let's start with the law. The requirement comes from Part 9 of the Companies Ordinance, Chapter 622 of the Laws of Hong Kong. Under Section 379, the directors of every Hong Kong incorporated company must prepare financial statements each financial year, and those financial statements must be audited by a Hong Kong practicing certified public accountant. This applies regardless of your company's size, revenue, or profitability. A one-person company counts. A company that made a loss counts. A company with only a handful of transactions counts. This surprises founders coming from places like Singapore or the UK, where small private companies can often skip the audit entirely. Hong Kong is different. There is no audit exemption based on being small. If your company traded at all, plan for an audit. The big misconception: reporting exemption is not audit exemption. Now, here's where most of the confusion comes from, and you'll see this mistake repeated on many websites. Hong Kong does have something called the reporting exemption, set out in sections 359 to 366A of the Companies Ordinance. A small private company qualifies if it meets at least two of these three conditions: total revenue of no more than 100 million Hong Kong dollars, total assets of no more than 100 million, and no more than 100 employees. But, and this is the critical part, the reporting exemption only simplifies your financial statements. It lets you prepare them under a simplified reporting framework with fewer disclosures. It does not remove the audit. The company's registry is explicit about this. Audit is required for all companies, including companies within the reporting exemption. So if someone tells you your small Hong Kong company can opt out of audit, they're mixing this up with something else, which brings us to the one real exemption. The only true exemption: dormant companies. The only Hong Kong companies genuinely exempt from audit are dormant companies, and this comes from two specific provisions. Under Section 5 of the Companies Ordinance, your company must pass a special resolution declaring itself dormant and deliver it to the company's registry. Once it takes effect, Section 447 switches off the accounts and audit requirements for as long as the company has no relevant accounting transactions at all. And no transactions really means none. Even a single bank charge or a small payment received can break dormant status, at which point the audit requirement applies again for that period. Dormancy suits companies that are genuinely on pause, for example, holding a brand name for future use. It is not a way for an operating business to avoid audits. If money is moving, your company is not dormant. But my company is small, or made no profit, or is offshore. Let's deal with three situations founders often hope are exceptions, because none of them are. First, small revenue. There used to be a concession where businesses with gross income of no more than 2 million Hong Kong dollars could file their tax return without attaching supporting documents. That concession was removed in April 2023. Today, all active corporations must submit their profits tax return together with their financial statements and tax computation. And for Hong Kong incorporated companies, that generally means audited financial statements. Second, no profits. A loss-making year doesn't remove the audit or the filing obligation. Third, offshore claims. As we explained in our profits tax video, claiming the offshore exemption requires filing your return with audited financial statements. In fact, a credible audit matters more when you're making an offshore claim. It's part of the evidence the Inland Revenue Department relies on, how the audit actually works, and when to start. So what does the audit involve in practice? You appoint a Hong Kong practicing CPA firm as auditor. Your company provides its accounting records, bank statements, invoices, contracts, expense records, together with the financial statements to be audited. The auditor examines them and issues an audit report, which then supports your tax filing. Here's the timing insight most first-time founders miss. Your first profits tax return typically arrives around 18 months after incorporation, with 3 months to file. The audit must be completed before you can file, and a first audit commonly takes several weeks, longer if your records are messy. So don't wait for the tax return to land before you start. Close your books, pick your auditor early, and the deadline becomes routine instead of a crisis. Common mistakes to avoid. 4 mistakes we see repeatedly. 1. Assuming overseas rules apply. We didn't need an audit in Singapore, so surely not here. Hong Kong is stricter on this specific point. 2. Starting the audit only after the tax return arrives, then paying rush fees to meet the deadline. 3. Poor bookkeeping. The audit is only as smooth as your records. If your bookkeeping has been neglected, the auditor has to reconstruct it, which costs you time and money. 4. Informal dormancy. Some founders simply stop operating and assume the obligations stop too. They don't. Without the formal dormancy procedure, an inactive company still needs financial statements, an audit, and tax filings every year. Summary and key takeaways. To summarize, every active Hong Kong company needs an annual audit by a Hong Kong practicing CPA. There is no small company audit exemption. The reporting exemption simplifies your financial statements, but does not remove the audit. The only true exemption is a formally dormant company with 0 accounting transactions. Since April 2023, all active corporations file their tax returns with audited financial statements attached. And the winning move is simple. Keep clean records from day one and start your audit well before your tax deadline. So, does your Hong Kong company need an audit? If it's active, yes. Plan for it, and it's a routine annual step rather than a problem. How Captime can help. At Captime Corporate Management Limited, audit and tax filing support is one of our core services for foreign founders. We keep your bookkeeping audit-ready throughout the year, prepare the financial statements, coordinate the audit with practicing CPA, and handle the profits tax filing that follows, including offshore claim documentation where it genuinely applies. If dormancy is the right route for your situation, we can handle the formal procedure correctly. If you're unsure where your company stands or your first tax return is approaching, book a free 15-minute consultation at captime.hk or use the link in the description. No credit card, no obligation. Key takeaway. An audit in Hong Kong isn't a punishment. It's part of what makes a Hong Kong company credible with banks, investors, and the tax authority. Know whether the requirement applies to you, keep your records clean, and start early. That's the whole game. Thank you for watching. If you found this video helpful, please like and subscribe for more practical content on Hong Kong company setup, tax, and compliance. See you in the next video.